Welcome to Purple Pond YouTube channel. Today we will discuss about capital protection portfolio strategy. Whenever we invest into mutual funds or any other asset class or any other product, one of the stated need is we are looking for returns. But the unstated need of any investor is capital protection. Anybody who is wanting to part with the money always looks for his capital to be protected at the end of the investment tenure. So, as you all appreciate, the equity as an asset class is the only asset class which can give you inflation beating returns. You can expect a 10 to 12% return from an equity investment. However, this does not come with a linear return, or people who are used with a fixed income investment will not be able to stomach the volatility of the variation of equity investment. If the variation of equity is bothering an investor, now will the investor be able to have the entire investments onto debt instrument and create wealth? That is also a question mark. So because the debt or fixed income securities are capable of delivering an inflation equal to inflation returns or slightly more than inflation returns. Wealth creation is very difficult when you are trying to invest only in fixed income securities. The fixed income securities are very linear, so any conservative investor would love to have the fixed income investment as the price fluctuations are not experienced. So now we have two worlds, one which gives you a linear return but low return. You have other bucket of investment which gives you higher returns but you will have to stomach the fluctuations. Do we have a mechanism by which you can have best of both the worlds? Yeah, we can try to formulate a strategy where you can enjoy benefit of both the asset classes. As we have in our daily walks of life, n number of hybridization strategies, right from your seedless grapes. Hybridization is trying to have best of both the worlds. So the fixed income security and the equity are mixed at a particular proposition and a fund is launched. These category of funds are called conservative hybrid funds. These conservative hybrid funds will have 80% of their investment into fixed income or debt securities and 20% of the income will be in equity shares. How does it behave on a investment avenue? How does it behave on a portfolio? Let's look at the stock market giving you return in the range of -20 to +20%. If the return is going to be -20 to +20%, we will now create scenarios to understand what will be the expected portfolio return if you have selected this conservative hybrid funds. We assume the debt portion of the portfolio to deliver 6% returns. If we assume 6% returns on the fixed income portion and build scenarios based on the equity return from -20% to +20%. If the market will deliver -20% in that year, your expected portfolio return will be 0.8%. Your capital still is intact, so you will just earn less than 1% on your investment. Suppose in a year the equity market does extremely well and the broader indices are giving you 20% price increase, then your portfolio is expected to deliver 8.8%. So with this two extreme conditions, your portfolio expected return would be in the range of 0.8 to 8.8. What is this minus 20 to plus 20 range? Apart from acute crisis like a financial crisis of 2008 or a pandemic like situation of 2020, markets have been in this range on so many occasions and years. So if you leave alone the outliers of the deep drawn market conditions, minus 20 to plus 20 is a safer zone to assume. When you build scenarios, your return could be anywhere between 0.8 to 8.8. So now let's compare it with our fixed income. If the market returns somewhere close to 10%, then your expected return is going to be 6.8%. So which beats your fixed income by a huge margin. Will this fund gains be taxed? Yeah, these funds will also have the capital gains being taxed. Long-term, short-term gains. These funds will follow a debt taxation. If someone is looking at the screen and asking what is debt taxation, I would strongly recommend there is a video on mutual fund taxation which you can refer to in our YouTube channel, and there we have explained what mutual fund taxation is all about. The conservative hybrid funds will be taxed as per the debt taxation, and long term is 3 years. If you stay invested for 3 years, it's a long term. If you stay invested for less than 3 years, then it will be taxed at your marginal rate of taxation. And when you are staying invested for 3 years, it will enjoy the long-term capital gain condition, and you will be allowed to have the indexation benefit also. Okay, having said all this, you will have a tax optimized, better than FD kind of return if you are trying to invest into this conservative hybrid funds. Let's assume for whom this investment product would be most suitable. This product would be most suitable for very conservative investor or an investor who is coming in to the market related securities for the first time, to give him a smooth experience of investing into market related products. Third, very important class of investors, people who have taken the risk, accumulated corpus using the equity as an investment asset class, but they are nearing the goal year or they are nearing their retirement age. If these are the conditions of the portfolio, now the investor can move from the 100% equity or 65% equity, 35% debt kind of products into this conservative hybrid products where your equity is limited to only 20%, and you can move from a 100% equity investment into this 20% equity investment. 80% will still be in debt, and your stability of portfolio will be increased to a large extent. So this can be used as an effective investment destination where your capital getting protected is on a very high probability, and you can also advise people who have not been into market related investments to take this route, taste the success of the portfolio and grow their portfolio and slowly move on to higher equity allocated products. Thank you for watching this video. Let's meet in the next video with yet another concept or strategy. Thank you.